This is a situation that it seems to occur increasingly, or maybe just it's something that I've just picked up on. I don't know, but you can have markets that have a clear directional bias, but they're quite two-sided. And periodically in the DBSA, you'll hear me say, well, this market is up, but it's a very two-sided advance, and you are expecting a sharp move here, just as you would expect if a market were in one of these nice, pristine balance areas with a well-defined upper and lower extreme. You can also have that two-sided market with a bias, and increasingly, and again, maybe it's just because of a perceptual change on my part, these are markets that are tradable, and you want to be paying attention to them because you're going to get the initiative move. So they're basically markets that have a directional bias, but they're really not initiative in the way that we think of in terms of initiative behavior. It's either happening more, or it's just something that I've become more sensitive to recognizing. Now, this is the traditional balance area, the two-sided market. It's where you have, the box where you have fairly obvious symmetrical consolidation. The highs, the market tends to trade almost to the high and then almost back to the low. And the definition of this is 4 swings. Everybody always wants to know, when do you know when a profile is mature? Well, the answer to that is you never know, which is an unfortunate thing, but it's just the reality. And there are all sorts of attempts still to program this. And the good news is you can't program it. Anything that can be programmed, the edge will go away. That's what's great about this. So our traditional balance area, now you have a trend like this, and then there's a stopping price in here somewhere, and then the market retraces. Just, you don't know where it's going to retrace. You just stop. Sometimes it just stops out of the blue and retraces. And this is why there is no reason to be selling this. There's none whatsoever. There is no edge. It's just plain dumb. Don't do it. Don't sell spikes. It's unnecessary. You're going to get, the odds are overwhelming if you're just chomping at the bit to fade something, that you'll get another shot at this, and you'll have something reasonable to lean against. So our balance area will be, the beginning of a balance area is when you have a vertical move and then you have a retracement. Now, when I see this, the alerts start going off. You guys will hear me talk about this stuff in the reports. Hopefully, the DBSA now will be of more value to you because you'll understand what I'm saying. And I'm really saying a lot. I mean, in these reports, I think I'm very consistent about how I analyze these markets and the information I'm giving and the structure and the conditions that I'm describing. I'll say, okay, we've got a retracement now. We could be forming a balance area. The perfect example of this is beans. We may have a balance area forming in beans. Well, I pointed that out when we had that first retracement back up. I said, it could be this. You begin to look for these opportunities because they recur over and over. So the first sign of that this is a stopping price and this could be balance is you get this spike, and then you have a retracement against the primary trend. Now, the thing that I'm not expecting this, if this is a larger degree move, I'm not expecting for this to be completely retraced. But I'm also not, I don't have to catch a falling knife here either. I don't have to buy this spike either to the downside. And this is where the patience comes in, and it's also what the basis for the patience in being an auction market trader. You understand there is a process of development that is recurring, and it is occurring in all degrees of trend all the time. And if you lean on that process and you trade the probable, you don't have to trade the improbable. And that is where and why there's an inherent expectancy in just the worldview of this methodology. Okay, so we're beginning a balance here. I've got a swing down now. Now I have a swing up. Now, whoops. Now this doesn't have to come all the way back to here exactly. It can come to here and stop, or it could go to here and stop. And I don't know, I'm not going to know that this is balance forming. Now, if this turns down, then I have the potential test of this, which is one requirement. The next requirement is a test of this. And it doesn't have to be, it doesn't have to come right down to it. There's a range here. Just look familiar. So this is right now, based on the information I have here, this is a resumption of the trend. This was just a one-off news retracement, and we're off to the races again, right? But if the market begins to trade, trades back into this range, and now at about here, I'm thinking, all right, well, maybe this is a balance area. And I'm not going to go long here. I'm not going to go short here. Because why? Anything that I do here is 50-50. If I go short here, my stop has to be here. And my expectation at this point is to about here. If I go long here, my stop has to be here. And or if I go short, or what did I say? If I go long here, my stop has to be here. My expectation is here. If I go short here, my expectation is here. My stop here. So it's 50-50. There's no edge. So if I'm looking at this market and it's here, I can't do anything. There's nothing to do. I don't have an edge. From a market condition, market structure perspective, there's no edge at taking this trade here. So, but if it comes here, then I have an edge. Now I have the minimum that I have to have to think that this is a balance area, as long as this turns back up and takes out the, to make it official, takes out the midpoint of this. Then I've got 1, 2, 3, 4 swings. And I'm including, the last leg of the initiative move up as part of that balance area, because my stopping price in hindsight, and it's only identifiable in hindsight, is probably in here. This is where the market began to get more two-sided. And it stopped here, we rotate down, we rotate up, and then we do this number. Now, and I'll get into this in a minute, the question is, when do I know to start looking for the initiative trade? Well, at this point, you probably, I don't have a problem fading a market, on a third test of an extreme like this whatsoever. I'll take that trade if it sets up. Now, occasionally, it's going to continue higher and you get stopped out. Okay, that's fine. That's just the way it goes. But now, if this market does this, and then it does this, and then let's say the market comes back down here, and it starts back up. There is no way I'm fading this. As a matter of fact, now I'm thinking, okay, I'm starting to see, this is a mature structure. It's holding the high volume node. above it, and this is just exactly what happened in the case study that we just did. So I'm going to look for the opportunity to go long here. Now the reality is I might go long here, and then the market turns, it's not through, and it comes down again. It's going to happen, but there is no such thing as a trade system, whether it's mechanical or discretionary, that doesn't have losses. All you can control is your decision-making process, and you want it to be as consistent and as objective and as purposeful as possible. So when you take a trade, the important thing about the trade is the process. It's not the individual result. Some of you guys are sending me your trades, and it's awesome. It's just great. And when I look at these trades, I get incredible information about. And the first question I have, I don't care if the trade is a winner or a loser. I'm interested in the thought process. I'm interested in the process that's being followed, because that ultimately is where you're going to succeed in this business, is fine-tuning and defining and tightening up the thought process around when and where and why you trade. Raj, you have a question, and I apologize, I just saw it. You say, is there a tell as to the direction of the break in two-sided market with upward bias up or down? We're going to look at some examples. So this, the example we just saw was your nice boxy symmetrical area. Now your directional two-sided market, it's lacking in conviction. And what it is, it's a tug of war between the big money participants. If the market has an upside bias, but it's just labored, overlapping day after day, grind higher, the sellers won't let go of it, and the buyers can't take control. So you've got big money driving this thing, grinding it directionally. At some point, somebody's going to win, and when they do, you really get some sharp moves. All right, this is, I'm going to show you guys some examples. This was crude, and this was back in 2012, and we had you had a balance area that formed, and then you broke down, and it really couldn't get initiative down, and then you had this chop higher. Now, there are a couple of things about this that made it a great situation to trade. Number one, you had this just big-time fight, just a grind to try and get this thing higher, and it topped out. Look at this. What's this? That's a high volume node, isn't it? You guys recognize that? And then the market just fell out of bed big time. All right, now this is the S&P Mini, and here's an example, and this was last summer. You had this initiative move higher, and then as expected, there was follow through, but it was very two-sided. And Raj, I have not been able to figure out the probability of the break up or down yet to see if there's some sort of pattern inside that tells you. The best I think you can do is to, if you recognize it, then you probably need to put an alert or just put an order under the most recent bar or over the most recent bar, just as a stop order. But so far, if there is a tell, it's eluding me. But I am paying attention and trying to figure that out. Now this is a little more. This is a multi-month grind here that we had into this November low. We trade sharply lower and then form a balance area, bungee jump up lower. This will drive you insane. And then we finally had a release lower into the November low and then up. And look at this. Now, this is sort of interesting because what we ended up here so far is a false breakout because this did break initiatively higher, but now it's broken below this to the downside, so it's turned into a false breakout. Okay, now this is the euro, and this chart is a wonderful example of both types of two-sided trades, and both types occurred fairly frequently. I mean, you just don't get a better, more pristine balance area. And this is a daily chart, guys. It's not like this is a 5-minute chart. And when you have situations like this, and we get them all the time, you really want to be looking at those markets to trade. So you had this big balance area here. And look, this is almost a classic initiative break lower. You really didn't have any sort of angst over, all right, is it going to come back and take me out or not? It was pretty much, once it started, it acted initiatively. And here was another one. And then you had this grind higher. Now, if you look at this, you had this very important level here to the downside. And when this broke, this level came out pretty quickly following the initiative move down. Hey, and Raj, I just thought about something else. The reality of this is, if you see this and then you get the wide initiative day, if nothing else, it's telling you the directional bias that you should be looking at until the idea that it's not going to be initiative is invalidated. And that itself is good information. So here it is to the downside. Here it is to the upside. You had this two-sided grind, and then this market took off. Here it is on a more, a little bit smaller scale, but I think it's pretty clear that's what this is. It's a two-sided grind higher. It's not this nice, neat balance area. Now, this is a more pristine, classic balance area. Here's a more pristine, classic balance area. Now, I talked earlier and really hammer home the fact that you have to take initiative trades and that you have to train yourself to identify balance. Spend time at night going through charts, go through past charts, go through different contracts. And I think it will be motivational for you to do that. Because if you look at this chart, if you had just sat there over this time frame, this is February, this is a year, this is a 12-month period, and waited for the initiative situations out of these pristine balance areas, you would have had a better year than 99% of the people that trade. Now, you wouldn't have traded that much, and there would have been months where you didn't take a trade. But and that's just trading one contract. But you think about it. If you're looking at 5 or 6 contracts, at least every week or 2, you're going to find this nice pristine balance area on a daily time frame, and then you can drill down from there, and that can be what you focus on and trade. Chris, good question. You say, when you're new, how many markets would you look at? I would look at least, I would start looking, Chris, at 5 or 6 markets. You don't have to trade them all, but I would begin to get, a familiarity, comfort level with them. And it makes sense to look at the markets that you can afford to trade. If you are a smaller capitalized trader, you want to look at, the NASDAQ, you want to look at the Canadian dollar, the Australian dollar. You could trade mini crude. What else, Troy? What else am I missing? Maybe corn versus soybeans. That's 4 or 5. The dollar index. That's 6. British pound. All right, that's 7. So, if you were a smaller capitalized trader, there's still plenty of opportunity and plenty of markets for you to look at to find the quote-unquote ideal trade setup before you jump in and you start forcing things because you're missing something. You're afraid you're going to miss something, or you're sitting there for 3 days and you haven't done anything, and you think that if I'm not clicking the mouse, I'm not working. Well, the reality is that's something else you need to get used to. Not trading is trading. All right, here's gold. This was back in 2011. Here's the top here. Actually, here's an example of it to the downside here. Lean hogs. And once again, I'm putting this in here not because I expect you to necessarily trade lean hogs, but it's to show you as much as anything the robustness of this approach. In this particular instance, robust meaning it works in all markets. And you also have, if you notice in lean hogs, you also have the nice pristine boxy balance areas as well. Now, here's the YM. YM was a classic false breakout today. Actually, the indices were on that spike up this morning. All right, hold on a second here, guys. Okay, one other chart I want to show you. Troy, you said that I saw something you posted there that the Australian dollar today had a, let's look at that. Oh, up here? Yeah, for sure. This? Yeah, and not only that, but look where it ground to. I mean, and then then you had this little setup in here. I don't know what time this was. Well, this is 4:30 in the morning. And actually, the entire move here, and this may be what you were talking about, Troy. This entire move was just ridiculous. And then to top it off, the test was ridiculous. And now you have this. You can see who won this battle, or at least who's winning at this as we're speaking. So guys, you can see, these things, they're out there in all the markets.